Imagine standing in front of a locked vault. Behind it sits a fortune large enough to transform your entire life. The world says the only people who can open are Wall Street insiders, financial geniuses, and people born into wealth. But what if the truth was the exact opposite? What if ordinary individuals, with ordinary incomes, could reliably build extraordinary wealth simply by understanding how markets really work? And what if the greatest danger in investing isn't risk, but our own behavior? This is the central message of Burton Malkiel's investment classic, A Random Walk Down Wall Street, a guide that has shaped millions of investors, transformed the financial world, and proven that beating the market isn't a game of brilliance, but discipline. Today, we walk through the entire book, chapter by chapter, to unlock its most powerful ideas and realities that can help anyone create lasting wealth. In the introduction, Malkiel reflects on the 50 years since the book's first publication. His central idea remains unchanged. Most investors will be far better off buying and holding a low-cost index fund than trying to beat the market through stock picking or active mutual funds. The book opens by comparing two hypothetical investors starting in 1977 with $10,000. One invests in an index fund, the other in the average actively managed fund. By 2022, the index fund grows to more than $2.1 million, while the actively managed fund reaches around $1.47 million. The lesson is clear. Time and low fees outperform expertise and trading. Malkiel explains the efficient market hypothesis, that stock prices already reflect available information, meaning opportunities for extraordinary returns without extraordinary risk do not persist. Investors who attempt to time markets or pick winners generally fail. Two-thirds of professional mutual fund managers underperform index funds each year, and over 10 to 15 years, around 90% fall short. The introduction ends by establishing the core philosophy. Investing success is simple, achievable, and built through discipline, diversification, and patience, not prediction. Part 1. Stocks and their value. Chapter 1. Firm foundations and castles in the air. Investing has always been divided between two philosophies, two opposing lenses through which investors attempt to understand what determines the price of any asset. Burton Malkiel begins this chapter by explaining these two dominant theories, the firm foundation theory and the castle in the air theory. Both have influenced generations of investors, and both continue to shape Wall Street behavior. The firm foundation theory argues that every investment has an objective, measurable intrinsic value determined by analyzing its expected future cash flows, earnings, dividends, and growth. According to this view, prices may move irrationally in the short term, but eventually markets correct themselves and return toward true value. Investors following this approach prefer logic and mathematics over sentiment. They typically examine financial statements, industry trends, revenue growth, and discount future earnings using interest rate assumptions to determine what a stock is truly worth today. When a market price drops below intrinsic value, they buy. When it rises significantly above it, they sell. This theory became the cornerstone of traditional investing, famously supported by economists and investors like Benjamin Graham and David Dodd. Their book, Security Analysis, shaped generations of value investors. Warren Buffett is widely considered the most successful practitioner of this foundation-based approach, consistently investing in businesses whose intrinsic value exceeds market price. Yet even this method relies on forecasting the future, a process filled with uncertainty, assumptions, and estimation errors that can dramatically alter valuation outcomes. In contrast, the castle in the air theory focuses not on underlying value, but on predicting how the crowd will behave. Introduced most notably by economist John Maynard Keynes, the theory states that investors are less interested in what something is worth and more interested in how much others might be willing to pay for it in the future. Keynes famously compared stock investing to a newspaper beauty contest, where the goal is not to choose the faces you find most attractive, but to choose the ones the crowd will likely select. Success lies in predicting psychology, expectations, and social behavior rather than evaluating fundamental value. This perspective gives rise to speculative frenzies, where price movements are driven by enthusiasm rather than substance, building imagined future value like castles floating in the air. Investors rush and not because they understand the business, but because they fear missing out and believe they will sell to someone even more optimistic later. This is known as the greater fool theory. The chapter then introduces the concept of the random walk. If stock prices reflect all available information, and news arrives randomly and unpredictably, short-term price movements are impossible to forecast. This challenges both chart-based prediction and the idea that analysts can consistently forecast trends. The randomness of market movement means that sometimes a blindfolded monkey throwing darts at stock listings could select a portfolio that performs as well as one chosen by professional analysts. Malkiel uses this chapter to set the stage. Investment markets are shaped by both analytical logic and emotional speculation. But understanding why markets behave as they do requires studying human behavior and history. Chapter 2. The Madness of Crowds. Malkiel turns to dramatic historical lessons to illustrate the dangers of ignoring intrinsic value and blindly following collective excitement. He argues that greed, fear, and herd mentality have repeatedly produced speculative bubbles that defy logic until they collapse violently. The tulip mania of the 1630s in Holland is one of the most striking examples. Tulips were new, exotic luxury flowers desired by the wealthy, and rare varieties infected with mosaic virus created unique multicolored patterns that were considered priceless. Prices began climbing rapidly, and soon people from every profession, nobles, sailors, merchants, laborers, abandoned practical work to trade bulbs. Bulbs were exchanged for houses, land, livestock, and fortunes. Options trading emerged, allowing people to speculate with leverage. But when confidence broke suddenly, panic selling erupted and bulbs that once sold for the price of a mansion became nearly worthless. A century later, the South Sea bubble followed a similar pattern. The South Sea Company promised enormous riches from trade in South America, and the British Parliament endorsed it, inflating public confidence. Stock prices skyrocketed as investors borrowed money and sold possessions to buy shares. Soon hundreds of new companies began offering absurd business proposals, including one venture described only as an undertaking of great advantage, but nobody to know what it is. Investors didn't care whether the ideas made sense. They believed they could sell to someone else at a higher price. When directors began selling their shares, panic took over, the bubble burst, and many were financially ruined. The chapter concludes with the lesson that crowd psychology, when detached from logic, can overwhelm markets. Prices may climb for months or years, but the higher they climb beyond reason, the more severe the eventual collapse. Outguessing the crowd is nearly impossible. No one can predict when a frenzy will end. Chapter 3. Speculative bubbles from the 60s into the 90s. The pattern seen centuries ago repeated in the modern era. Malkiel details how speculative optimism drove markets during the 1960s and 1970s. Investors became fascinated with growth stocks, new technology, and aggressive conglomerates. Companies promised synergy-based expansions and acquisitions, creating the illusion that corporate size guaranteed success. The new issue craze fueled excitement as IPOs multiplied at astonishing pace, and investors bought shares purely on excitement rather than financial reality. This era also produced the Nifty 50, a group of supposedly perfect stocks that investors believed were impossible to overpay for. Companies like IBM, Coca-Cola, and Xerox were considered so invincible that investors valued them at extremely high price-earnings multiples. The market believed these companies would grow forever, and that owning them was a risk-free investment. Eventually, reality intruded, growth slowed, confidence fell, and the stocks collapsed dramatically. The roaring 80s were dominated by junk bonds, high-risk debt instruments marketed as vehicles for fast corporate expansion and leverage buyouts. IPOs soared again, and fraudulent operations like ZZZZ Best demonstrated the power of illusions in financial speculation. Meanwhile, Japan experienced one of the most extreme bubbles ever recorded. The value of land in Tokyo exceeded the value of the entire state of California, and the Imperial Palace grounds were priced higher than the whole state of Florida. Each of these episodes reinforces the lesson. Every generation believes that innovation makes old rules obsolete, and every generation eventually discovers they were wrong. Chapter 4: Explosive Bubbles in the Early 2000s. The dot-com bubble of the early 2000s became one of the most dramatic financial disasters in modern history. Internet startups, many without revenue or profits, attracted massive investment on the hope that digital technology would reshape the future. Traditional metrics were abandoned and replaced with speculative measures like page views or eyeballs. Prices rose rapidly as media hype fueled public obsession. Stocks such as Pets.com and Webin soared at IPO and collapsed shortly afterward. The Globe.com, which once rose more than 600% on its first trading day, became worthless. Fraud emerged as expectations exceeded reality. When confidence cracked, the Nasdaq index fell almost 80%. After the dot-com crash, another bubble emerged: the U.S. housing market. Financial institutions loosened lending standards, creating complex mortgage-backed securities, enabling buyers with weak credit to borrow large sums. Investors believed real estate prices could never fall. The bubble burst, leading to the 2008 global financial crisis, bankrupting banks, destroying trillions of dollars, and triggering a worldwide recession. The chapter ends with modern examples, including meme stock mania, such as GameStop and AMC, driven by online communities rather than financial fundamentals, and cryptocurrencies like Bitcoin, which Malkiel argues resemble speculative bubbles because they rely primarily on belief rather than measurable intrinsic value. Part 2: How the pros play the biggest game in town. Chapter 5: Technical and Fundamental Analysis. Malkiel now examines the strategies used by professional investors. Technical analysis relies on price and trading volume charts to predict future price movements. Chartists believe patterns repeat themselves and that trends exist that can be exploited. However, if such patterns offered reliable profits, competition would quickly eliminate them. Many chart-based strategies appear profitable only before accounting for real-world costs like fees and taxes. Fundamental analysis, in contrast, attempts to evaluate real business performance by studying earnings, dividends, assets, competitive position, and industry conditions. Analysts try to determine intrinsic value and forecast future profits. However, even experts fail frequently. Predicting business conditions years ahead is extremely difficult. Inconsistencies in forecasts and differing assumptions make fundamental analysis far from foolproof. Both methods attempt to reduce uncertainty, yet neither can reliably or consistently outperform a market. Chapter 6: Technical Analysis and the Random Walk Theory. This chapter expands on the weaknesses of technical analysis and popular trading systems, such as the filter rule, Dow theory, relative strength models, and price-volume systems. Malkiel also highlights absurd indicators like the hemline indicator and the Super Bowl indicator to show how easily false patterns can appear convincing. While randomness makes people uncomfortable, the evidence shows that past price movements do not effectively predict future performance. The central message: markets incorporate information quickly, making price changes unpredictable and mathematical forecasting unreliable. Chapter 7: How good is fundamental analysis? The efficient market hypothesis. Here, Malkiel evaluates fundamental analysts and professional investors. He argues that, despite enormous resources, mutual fund managers generally fail to outperform index funds consistently. Many factors limit success: unforeseen events, accounting manipulation, human judgment errors, conflicts of interest, and the tendency for top-performing managers to lose talent to hedge funds. Year after year, 2/3 of mutual funds underperform the market, and those that outperform rarely repeat. The efficient market hypothesis concludes that market prices reflect available information quickly, meaning extraordinary gains require extraordinary risk. Markets may be imperfect, but they are difficult to beat. The implication for investors is clear. Long-term, disciplined investing through diversification and low-cost index funds remains the most reliable path to wealth. Part 3. The New Investment Technology. Chapter 8. A New Walking Shoe. Modern Portfolio Theory. In this chapter, Malkiel introduces modern portfolio theory, MPT, one of the most influential frameworks in finance. Before this concept was developed, most investors evaluated investments individually, believing that owning more stocks simply reduced risk through quantity. MPT changed everything by demonstrating that risk reduction does not depend on owning many investments, but rather on owning a combination of assets that behave differently under different market conditions. Malkiel begins by defining risk as the variability or volatility of returns. A stock with very wide price fluctuations carries more uncertainty than a stable one. Investors naturally seek higher returns, but want to avoid excessive volatility. Balancing these two goals is the foundation of portfolio strategy. The chapter uses simple illustrations to show that individual investments are unpredictable, but combining them can dramatically smooth overall performance. If one stock falls while another rises, the gains can offset losses. This is diversification, not merely owning many assets, but owning different kinds whose price movements are not perfectly correlated. Harry Markowitz, the pioneer of MPT, mathematically proved that the risk of a portfolio depends on how assets interact rather than how risky they are in isolation. He showed that adding assets with low correlation to a portfolio creates an efficient frontier, a curve representing the best possible return for each level of risk. Rational investors should choose points on this curve. The key insight is that diversification is the only free lunch in finance. Malkiel concludes that long-term investors should build portfolios that include various types of assets, such as domestic and international stocks, bonds, real estate, and cash, rather than concentrating heavily in a few stocks, even if they seem promising. Diversification protects investors from unforeseen events and market uncertainty. Chapter 9. Reaping Reward by Increasing Risk. This chapter explores the relationship between risk and reward. While investors prefer high returns and low risk, financial theory states that higher returns are achievable only by taking on additional risk. The Capital Asset Pricing Model, CAPM, developed after MPT, formalized this relationship. CAPM states that the expected return on any investment equals the risk-free rate plus a premium that compensates investors for bearing market risk. This premium is determined by beta, a measure of how volatile a stock is compared to the market. A stock with a beta of 1 moves in line with the market. A beta above 1 means greater volatility, and below 1 means less. Malkiel explains that beta became widely used as a measure of risk and a guide to constructing portfolios. For many years, investors believed high beta stocks would consistently deliver higher returns. However, empirical research later revealed that this isn't always true, and that low beta stocks sometimes outperform high beta ones while offering less uncertainty. The chapter also introduces newer models like arbitrage pricing theory, APT, and the FAMA, French three-factor model, which suggests that multiple factors, such as company size and value characteristics, influence returns. Multi-factor investing attempts to exploit these advantages, but Malkiel warns that these strategies can fail for long stretches and often depend on historical patterns that may not repeat. He concludes that while theories help explain long-term behavior, no model can perfectly predict market performance. Investors should not rely solely on formulas, but should maintain discipline and diversification. Chapter 10. Behavioral Finance. Traditional financial theory assumes that people are rational decision makers. Behavioral finance challenges this by showing that investors are emotional, inconsistent, and often driven by instincts rather than logic. Malkiel highlights several psychological biases that distort investment decisions. Overconfidence. Investors believe they can outperform the market despite evidence showing otherwise. This leads to excessive trading, which typically reduces returns. Herding. People follow the crowd because it feels safer to be wrong collectively than right individually. Herding behavior contributes to bubbles and crashes. Loss aversion. Investors fear losses more than they value equivalent gains. This causes people to hold losing investments too long and sell winners too early. Anchoring and biased judgments. Investors fixate on past prices or irrelevant reference points, preventing objective decision-making. Pride and regret. Investors resist admitting mistakes because they want to preserve emotional comfort. Behavioral finance explains why markets experience extreme swings and why individual investors, on average, underperform simple index investing. People consistently buy high in moments of optimism and sell low in panic. Malkiel emphasizes that the biggest enemy investors face is not the market, it is themselves. The lesson: long-term success requires emotional discipline and resisting impulsive reactions. Chapter 11. New Methods of Portfolio Construction, Smart Beta, Risk Parity, and ESG Investing. In this chapter, Malkiel explores new investment strategies that gain popularity in modern finance. Traditional index funds weight stocks based on market capitalization. Smart beta funds attempt to improve performance by weighting stocks based on alternative rules such as value, size, momentum, or low volatility. Smart beta promises to capture higher returns by taking advantage of persistent factors like value stocks outperforming growth stocks, small companies outperforming large ones, stock price momentum predicting trends, low volatility stocks offering similar returns with lower risk. However, these factors do not always work consistently. They can underperform for long periods, leading investors to abandon them at the worst possible times. Moreover, selecting factors after they succeed historically may simply reflect chance rather than reliable patterns. Risk parity is another modern strategy that balances a portfolio so that each asset class contributes equal risk. Instead of weighting investments by dollars, risk parity weights them by volatility and often increases exposure to low-risk assets using leverage. The strategy performed well for decades, especially when bond yields fell, but performed poorly when interest rates rose. ESG investing, which considers environmental, social, and governance characteristics, has grown rapidly. While some investors support ESG because they believe it fosters responsible capitalism, others view it as a marketing narrative. Malkiel warns that ESG scoring lacks standardization and that high ESG ratings do not guarantee better returns. The central idea: new strategies are useful tools, but none eliminate risk and none guarantee superior performance compared to simple diversified index funds. Part 4. A Practical Guide for Random Walkers. Chapter 12. A Fitness Manual for Random Walkers and Other Investors. Malkiel now shifts from theory to practical advice, outlining step-by-step guidance for individuals to build sound financial strategies. He emphasizes foundational preparation before investing. Build emergency savings and maintain cash reserves to avoid selling investments during crises. Use insurance to protect against catastrophic losses, such as medical emergencies or property damage. Optimize taxes using tools like retirement accounts, Roth IRAs, employer pensions, and 529 college savings plans. Make sure investment objectives match risk tolerance and time horizon. Understand bonds and how they work within a diversified portfolio. He explains zero-coupon bonds, municipal bonds, treasury inflation-protected securities, TIPS, and foreign bonds. Explore alternative assets like gold and collectibles cautiously. They provide limited income and speculative value. Keep investment costs low. Fees compound against returns and can erode wealth dramatically. Diversify globally and across asset classes to reduce risk. The chapter concludes with a checklist. Invest regularly, rebalance periodically, avoid emotional mistakes, and avoid high-fee products. Chapter 13. Handicapping the Financial Race. Malkiel reviews historical periods of investment returns, emphasizing that markets move in cycles shaped by economic forces, investor sentiment, and external crises. He divides history into 4 eras: the age of comfort, the age of angst, the age of exuberance, and the age of disenchantment, to illustrate fluctuations in returns for stocks and bonds. He stresses that forecasting future returns is difficult, but long-term patterns show that stocks generally outperform bonds and cash significantly over time. Investors who stay disciplined and reinvest gains typically achieve strong wealth accumulation. The chapter also discusses recent market behavior between 2009 and 2022, where markets rebounded sharply after crises and demonstrated the resilience of long-term equity investing. Ultimately, the goal is not perfect prediction, but realistic expectations. Investors should focus on what they can control: savings rate, diversification, risk management, and time in the market. Chapter 14, A Life Cycle Guide to Investing. This chapter explains that ideal investment strategy depends on age, financial goals, and risk tolerance. Younger investors should allocate more heavily to stocks because they have time to recover from downturns and benefit from compound growth. Dollar cost averaging, investing a set amount regularly regardless of market conditions, reduces timing risk and increases efficiency. As investors age, they should gradually shift toward bonds, which reduce volatility and provide income. Rebalancing, periodically adjusting allocations to maintain targets, can reduce risk and improve returns by forcing investors to buy low and sell high. Malkiel also introduces target date funds, designed to automatically adjust asset allocation as retirement approaches. For retirees, he discusses strategies for managing withdrawals, annuities, and structured spending plans to protect against running out of money. The key message is that a disciplined, personalized plan produces better results than trying to time markets or chase performance. Chapter 15, 3 Giant Steps Down Wall Street. The final step-by-step investment strategy. Buy index funds, the no-brainer step. Use simple selection rules of stock picking at all if needed. Hire trustworthy low-cost advisors. The book ends by emphasizing that simple, disciplined investing builds wealth. Malkiel ends with stories from readers who built wealth starting with small amounts. He reminds us, anyone can succeed if they save consistently, avoid emotional decisions, and invest for the long term. The market rewards patience.